Everyone. I am C. Ravi Jain, moderator of this webinar. We are
Welcome,
delighted to
Gyan bhai.
welcome.
Thank you, Chairman sir.
Sir,
Welcome to
welcome,
you.
sir.
At London.
Yes. So nice. So when are we coming back?
Yes, coming on 30th
Okay,
Sunday
sir.
night. Sunday.
Welcome, Gyan, sir.
Thank you.
Welcome, members. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for this session on webinar on understanding tax regime for salaried employees and business combinations. In a short while, we will start this webinar. I would like to apprise you about CPE committee. The increasing globalization, continuing developments in the field of finance, and frequent changes in the world economic order have posed numerous challenges before the accounting profession worldwide. These challenges have significant implications on the growth and development of our profession and simultaneously have more expectations from the profession as a whole. It is indeed the responsibility of the professional bodies to provide members with adequate facilities and opportunities to meet the challenges thrown by the dynamic environment by continuously enhancing their knowledge, skills, and professional values. With this vision, the CPE Committee of ICI has been organizing a number of programs with the help of our program organizing units. The program for this evening is as follows. We have two sessions of 1 hour each, and topics are: first, understanding tax regime for salaried employees, and second, business combinations and subsequent purchase price allocation analysis. Our eminent speakers will talk about above mentioned two emerging areas of professional interest. Uh, we also have the chairman of CPEC committee, Sir CA Purushottam Khandelwalji, and vice chairman Sri Gyanchand Mishra ji. So I welcome you all, sir. And I would like to invite Chairman Purushottam Khandelwalji for his opening remarks.
Good morning, respected,
Morning, sir.
learned, my dear friends, council colleague, vice chairman of the CP committee, Gyan Mishra ji, very dedicated, always ready for the members, students, and profession. They are the key instrumental in organizing these programs for the members, respected faculty for these two technical sessions, Pankaj Kumar Trivedi ji and my dear friend Hitendra Ranka, moderator Ravi Jain ji, secretary of this committee Ajit Naji Tiwari ji, Rasmi ji, and respected members. It gives immense pleasure to be talking to you on this occasion of these CPE programs. Respected friends, the committee for CPE is always dedicated to upgrade the knowledge of members in the current scenario. The today's topic selected is very relevant for the members and public at large, and being the topic which is selected for the Hitendra Raka is a big businessmen, those who are involved in the merger, acquisition, valuation. So this is a very relevant topic. Everybody knows that the salaried employees have no bigger choice to tax planning, but whatever they get after reduction of the salary, and they are so much worried how to save the tax. So within the four corner of the legal framework, the Pankaj Kumar Trivedi will guide to the member how they can advise their clients to save the tax within the legal framework. And the other speaker, Hitendra Rankaji, is a very learned speaker on the corporate subject, merger, acquisition, and valuation. In the global scenario, I got an opportunity to meet chairman of the International Accounting Board at London yesterday. I also meet the High Commissioner Dorabji at London yesterday to find out the opportunity for the member of Indian Institute of Chartered Accountants, how they can be start a practice in UK and the European country. We have thoroughly discussed and we are planning to establish a full-fledged office in London to catering the need of the European countries. I have seen that in the Europe there is a huge financial market and a lot of opportunity for the members, those who are looking to, to make their career at abroad. So with this, I once again thank you, Ajit Naji, for organizing such a wonderful programs. Thank you, Gyan Bhai, for selecting such a beautiful topic. Thank you so much. Over to Gyan Bhai.
So thank you, Purushottam Bhai, very respected, chairman of the committee. Well said by Purushottam Bhai. The time has come when we have to see beyond the country. We have to look beyond the profession what we are doing as of now. Very visionary, chairman of the committee, who is a person. The day when he took the chair, since he's trying to take the committee to the next level by best use of the technology, by best of the resources to provide the dissemination of knowledge and skill to the members at large. C. Purushottam Khandelwal ji. Two learned speakers of today's program, C. Pankaj Trivedi ji and Hitendra Ranka ji. Two moderators, again, very young and dynamic, my younger brother Ravi Jain from Raipur, and of course, Madam has joined?
Yes, sir.
Madam Rasmi Bangla ji. She is also, Madam, I can see you now. Madam Rasmi Bangla ji. She is again from Raipur. Secretary of the committee, Ajit Nath Tiwari ji, and respected participants. Good afternoon to all. Friends, we all know that the time has come when we have to align our knowledge and skill to the contemporary knowledge, contemporary demand of the society and profession. So the two topics being selected by the committee are really fruitful, and this is certainly going to enhance the knowledge with respect to the first topic, that is this new tax regime, especially for the salaried employee, to be taken by a great professional CA, Pankaj Trivedi ji, who has a very wonderful experience, especially in the KPO, in the processing of the various knowledge-based data in the country. He hails from Hyderabad, and the other learned speaker amongst is Hitendra ji. He will be talking on various important topics related to the business combinations. So friends, I'll not take much time as our learned chairman sir has already briefed about the committee and the new initiatives. One thing just I would like to request all the participants who are viewing this program to kindly come with new ideas, new innovations, new topics on which you want to deliver and deliberate. The committee is open for the same, because we don't want to go for the old things which other committees has the full right to do. So CP is basically committee which must come with the novel ideas. So request all the participants who have joined the program to kindly just mail your brief profile, your topic on which you are interested to take as a speaker, or you want to be moderator, or you want to any type of resource person to contribute in the committee. You please write to us, and I'll request Secretary of the committee, Ajit Nath Tiwari ji, to kindly take the cognizance of the same and try to accommodate the good professionals for the work. So, friends, once again, I welcome each one of you from core my heart, on behalf of the committee, and on my own behalf, and of course on behalf of Chairman sir. And I'll request the moderator, CA Ravi Jain ji, to kindly proceed with the program. Thank you, one and all.
Thank you so much, sir. Both our dynamic leaders, Purushottam Khandelwal ji and Gyan Chandra Mishra ji, thank you for your opening remarks. Now I would like to introduce our speaker, Mr. Pankaj Kumar Trivedi ji. Sir, Pankaj Kumar Trivedi, he's a chartered accountant. He graduated from Badruka College of Commerce and Arts, Hyderabad in 1986 and qualified as a chartered accountant in January 1989. He's founder partner in the firm Trivedi and Bang. He was managing committee member of Hyderabad branch of SIRC of ICI from January 2016 till March 2022 and served as chairman of Hyderabad branch in the year 2020-21. Hyderabad branch won award at national level under his chairmanship. He served as vice chairman in 2019 and treasurer in 2018. He was chairman of SICASA in 2000 and 2017 when SICASA won the award for its performance. He was also committee member of Hyderabad branch of SIRC of ICI from 1998 to 2000. He was regularly co-opted as member of various committees constituted by ICI at central, regional and branch level. He's panel speaker in various institutions and has also regularly presented papers for Hyderabad branch of ICI and SIRC of ICI on academic interest. His main area of practice is payroll accounting and ETDS returns, and he's consultant to various multinational companies. He's a keen follower of cricket and loves to listen to soft Hindi songs. He's also a theatre artist and has also acted in 2 short films. Sir, after reading your profile, I must say you have a very dynamic personality. I would like to welcome you, sir. Uh, I would now like to invite you for the deliberation, and I would also like to inform our participants that we have more than 1,500 participants today. So, sir.
Yeah, thank you very much, Raviji. I'll just share my screen before I begin. Okay, just
Yes.
let me know if it's fine so that is my screen visible, Raviji?
Yes, sir.
And my audio is clear?
All good, sir.
Thank you. Good evening, everyone. Before we commence the meeting, I'd like to sincerely thank Continuing Professional Education Committee of ICI, especially C.A. Purushottam Ralji Khandelwal, Chairman, CP Committee, C.A. Gyanchand Mishra ji, Vice Chairman, CP Committee, Ravi Jain and Rashmi ji, moderators, Ajit Nath Tiwari ji, the man behind all the programs being done by the committee, Krishnakant ji, my fellow speaker Hitrendra ji, and all the participants. Friends, taxation of salaries, a subject which many chartered accountants in practice have not given much importance to. I understand we always got very good marks while writing the exam for the questions on income from salaries, and we started believing that taxation of salaries is a very easy thing. While I appreciate the situation, I would like to tell one point why we need to concentrate much more on this topic, taxation of salaries. What happens is during our busy office hours, we suddenly get a call from top management of the company asking a clarification on certain points, whether this is taxable, not taxable. And most of us, what we tend to do is to just give a straightforward opinion, ye taxable hai or ye taxable nahi hai. But look at the problem. So you are given the opinion to top management who has got the opinion from a reputed chartered accountant, and that will be implemented straight away. So there's not much thinking point between you giving the opinion and the opinion being implemented. The opinion what you are given may have an implication of just 100 rupees per month per employee. But just imagine, even if a company is having 1,000 employees, the amount which has the implication will be almost about 12 lakhs per annum. So please understand, due to volume, taxation of salaries is definitely a very important topic. We need to think before we actually respond to our clients. So let us just go to the session today. We'll just see the background of the regimes. What are the tax rates and new and old regimes? Let us just run through, because all of you are sure I know you know about this thing. What are the deductions that are not available if you opt to choose for new regime? But we also need to know what are the deductions that continue to be available in new regime as well as in old regime. 2 or 3 small case studies we'll just see, and then let us see how we go with the decision making, whether you choose to be in a new regime or an old regime. So here, what happened was from 1961 till 31st March 2020, we all had a single method of taxation. It was very clear from the gross salaries. We were entitled to take the benefits of rent, benefits of interest, benefit of investments, and so many other things. And what we got was a taxable income. And that tax was, we had to calculate income tax on the residual figure at the predetermined slab rate. This continued till assessment year 2021, where on 1st February 2020, our Honorable Finance Minister came up during the budget presentation, and she said, friends, I would like to start a new regime of taxation. And the first thing she said was, in the new regime of taxation, the rates of tax will be as under. So now what happened? She brought a regime where the rates of taxes are drastically less. And just when I was thinking, why is she putting it as an option? Who would like to pay more tax? She continued the speech saying that I'm giving you an option to choose this new slab rates, which we call it as a new regime. But if you choose the new regime, then what is going to happen is that you'll not be entitled to several deductions which normally a person can get. Now, what happened was she had a figure of 15 lakhs as a cutoff point, and for the assessment year 21-22, on an apple-to-apple comparison, that is, if I calculate the tax on 15 lakhs and I calculate the tax in old regime as well as new regime, we observed that 75,000 is the tax which you pay less in new regime compared to old regime, and this was a huge figure. But what happened when we started checking the list of items where she said deduction will no longer be available, then the actual calculation started, and many of us formed groups, studied, and what we found was that 2,50,000 rupees was a figure which came as a break-even figure. And at that time, if an employee or if any person was able to get the benefit of 2,50,000 rupees on tax saving instruments, old regime and new regime was break even, and many of us were easily able to touch 2,50,000 and beyond, and majority of us were in old regime. So they also studied the trend, and still they found that there are not many takers for the new regime, even though the tax slabs are less. So finally, on 1st February 23, a more determined and a more proactive approach was adopted by the finance minister, wherein she just overhauled the complete new regime, and she made sweeping changes, we can say, just to ensure that new regime will be more and more accepted by people. So we all know one thing. Old regime or the traditional regime is one where we get tax benefits on all the investments, and on the residual amount, we pay the tax. A new regime is a regime where about 90% of the deductions are not available to you, and in almost all the cases or many cases, on the gross salary, tax is calculated as per slab rates and income tax is paid. So let us quickly see what is the old regime, what is the new regime, and other things. We are all very familiar with the tax. Okay, this is the tax rates you have been seeing for the last 5-6 years. There's no changes in this rate since assessment year 21-22. So except tinkering of surcharge here are there. So these are the rates with which we are paying the taxes. Here also there was a major news item saying that now person in India will not have to pay tax till 5 lakh rupees, which friends we all know it is wrong. If your taxable income is up to 5 lakh rupees, then you get a rebate of income tax which is equal to tax and you don't have to pay a single rupees tax. But even with the increase of 1 rupee taxable income, where if your taxable income is 5 lakh 1 rupee, this means your taxable income has increased 5 lakh rupees and you will not be entitled to rebate of 12,500. So you start with a payment of 13,000. So people who are in the old regime have this situation. Either you are paying zero tax or you start with a tax payment of 13,000 and there is no scenario where you will pay only tax of 0 to 13,000. I don't have to go and explain you how the tax is calculated. Then the surcharge created a problem. Too many slabs were introduced for the first time, okay, where it was only above a particular limit, surcharge was there. But what she did, above 50 lakhs, 10%, 50 to 1 crore, another percent, 1 crore to 2 crores, 2 crores to 5 crores, and above 5 crores, there is a surcharge of 37%. This is something what we need to keep in mind, friends, when you are in old regime. If your taxable income after all the tax benefits is above 5 crores, you pay a surcharge of 37% on the tax due. We'll come to it little bit later in the next slide. Then we had an education cess of 4%, which is irrespective of whether surcharge is there or not. Either on tax plus surcharge you pay 4%, or only on tax you pay a 4% education cess. So these were the rates which still continue for employees who choose to take the tax benefits. And now on 1st February 23, the finance minister proposed these rates and these rates were accepted and now have become an act. What are the rates? Look, she brought the slabs of 5%, 10%, 15%, 20%. Again, till 15 lakhs, it is the tinkering has happened. And for incomes above 15 lakhs, it continues to be 30%. So, as you can see from the table, as we are all from the profession, I don't have to explain you. You can yourself find that the tax slab, the taxation is much lower in the new regime compared to old regime. And again, as I said, in an apple-to-apple comparison, if I calculate the tax on 15 lakhs in the old regime, then what I find is on 5 lakhs at the rate of 30%, which is 1,50,000 plus 1,12,500, 2,62,500 is what I pay in the old regime. But in the new regime, I will be paying only 1,50,000 tax. So the first winning boundary for new regime started with a figure of 1,12,500. You were shocked. 1,12,500 is a amount you pay lesser on a similar figure if you are in new regime. Happiness started increasing and then they said, Dil mange more. Let us give them more. So what did she do? Then she moved to rebate. So here, when we talked about rebate, for the old regime, it was 5 lakhs, and the new regime, it was made to 7 lakh rupees. So ideally, if you calculate the tax on 7 lakh rupees in the new regime, your tax should be 25,000 rupees. And as if we add cess of 4%, it is 26,000. Now, what happens again here is, on a taxable income of 7 lakh rupees, the tax comes to 25,000, and the rebate under Section 87A is also equal to the amount of tax. So it's a zero tax. Now, in the new regime, you come to a situation where either you pay zero tax or you start with a payment of tax of 26,000 rupees. So my first word of caution, which we need to give to the employees. While working with employees, I have seen that they take the CTC and try to jump onto choosing an old regime or new regime. What they need to be very clearly told is, look, boss, it is not only the CTC. You get night shift allowance, you get referral bonus, you get statutory bonus, you get so many awards which are taxable, and everything combined. If the income is 7 lakhs, if it is nearing 7 lakhs, you have to be very, very careful determining in which regime you would like to be. Is that because if you just choose to blindly be in the new regime on a 7 lakh income, maybe you are just paying 7 lakh 10 rupees income, you are paying a tax of 26,003 rupees, which would be slightly high. So first thing was the rates were reduced, rebate was increased. Then a very important change was brought in, surcharge here. Now, if there is anything for people to choose blindly between old regime and new regime, my eyes would go to people who are earning more than 5 crores income. So in the old regime, the surcharge of 37% continues for employees having more than 5 crores taxable income. Whereas in new regime, the limit of surcharge is capped above 2 crores only. For every, once your income is above 2 crores, it stops at 25% and the 37% surcharge clause is removed. A high net worth individual who has got more than 5.5 crores income is just saving 30 to 35 lakh rupees tax by choosing to be in new regime. So if there is a blind rule, it applies to new regime people, but definitely this is what calculated. So what happened? You choose these rates and continue to avail all the tax benefits, or you can choose these rates and pay the tax. But when you are choosing these rates and paying the tax, what you find is all these deductions which are available to you if you choose to be in new regime are the ones which you have studied regularly, passed the exam, are no longer there in the syllabus. Let us quickly and briefly see what is it, how are they applicable. I'm not going very deep with everything, but at least the new applicability I would like to talk. Without going through the sections, because it won't look like a technical class. So the first benefit, what generally the employees get, leave travel allowance or leave travel concessions. We all know that 2 times in a block of 4 years, which is 22 to 25, an employee can submit the tickets for self, spouse, children, dependent parents, unmarried siblings, and on the tickets, tax can be saved. Travel, we all do. Yes, lethargically, we never had the time to submit the tickets to employer. But now, of course, if you are in new regime, you will say, I never submitted, I don't bother. But it is something which is there with everyone who is employed. But if you are in new regime, you will not get the benefits on new travel concession. Majority of us stay in rented house. We all pay rent, and if you are paying rent in the city of employment, that is for the house occupied by the employee, subject to conditions, we used to get tax benefit against HRA. Actual HRA 40 or 50% of basic, rent paid minus 10% of basic. I agree that your full rent paid will not get you the deduction, but rent paid minus 10% of basic was generally where we are all getting the tax benefit. It's a good figure, but that again is not allowed in the new regime. We all know that 200 rupees are deducted in every state except Haryana, where this 200 rupees deduction is not there. So once the 200 rupees professional tax, which is deducted, what happens is the 200 into 12, 2,400 rupees, automatic, we all used to get the deduction in old regime under 16.3. Now this is also not available. A very hidden and a very strange thing I'm just trying to bring because no one thought about it. Meal coupons. And this created a lot of problems in the first year, 2021 financial year. People continued to give the meal coupons. It continued to get exemption where no one bothered to check how many are in new regime and how many are in old regime. We all buy some coupons and give it to employees, and there was a deduction of 50 rupees per meal available to employee. So many companies said 50 rupees into 2 meals because our employees work hard. They have both lunch and dinner in office only or in the office premises. So 100 rupees, they normally work around 22 days in a month. So 22 rupees days into 100 rupees, 2,200 rupees were tax-free as per the section. But no one thought that this is also hit by new regime, where they say even this benefit, which comes under 1014, will not be available. Uniform. Of course, many companies were not giving uniform benefits, etc. But many companies which had the uniform also never bothered to think that uniform is removed. This is where I was trying to check up. Because when you are busy in a meeting, when a call comes from top management, so is food taxable, or meal coupons taxable or not? Invariably, our mind goes and tells not taxable. Don't worry, 50 rupees per meal is not taxable. And if that is implemented, and there are 1,000 employees, the company is straight away losing 1 lakh rupees per month because this benefit is not available to employees who are opting in new regime. Now we have to first check which regime the employee is, and then only we can allow the deduction for meal coupons in the new regime. Similarly for uniform. Now, the next important thing is interest on housing. Again, slightly interesting thing here. If we have to cover 95% of the salaried employees, they can be covered in item number 2 or item number 5. Either we stay in a rented house and pay rent, or most of us are encouraged to buy a house by our parents, which is a very good encouragement. Now we all know that So much money will not be available to us. Just go and buy the house. So we take housing loan, which is also a permissible thing. Now, what used to happen was whatever interest was there, we were getting tax benefit. Couple of years earlier than 2021 also, some tinkering was done. Earlier, loss from let out property was allowed in full, and then they restricted that loss also to 2 lakhs. And loss from self-occupied house, where the house is occupied by employee or the parents, we were getting a tax benefit of 2 lakh up to 2 lakhs rupees. Actual interest are 2 lakhs, whichever is lower, and this amount was deducted from taxable salary. This was the only loss which was allowed to be adjusted from salary, and nothing else could have been allowed. So on 2 lakhs rupees, we were getting tax benefit, we were happy. But now what they said, if you are having, or if you want to choose to pay tax under new regime, then you will not get the tax benefit on loss from self-occupied property. So instead of saying loss interest on housing loan, I use the words loss from self-occupied house property because there is a small change with respect to let out property. So what happens is, if there is a let out property, we all know that annual rental income less 30% is what we offer to tax, assuming there is no housing loan. Now say 10,000 per month is the rent we are getting, into 12 is 1,20,000, no property tax, 1,20,000, so 36,000 we deduct, 84,000 remains. Now if you do not have housing loan, you have to pay tax on 84,000 rupees. Now what if you have a housing loan interest again here? Thankfully, how we give a chocolate to crying baby, here also a chocolate was offered to us. They say, okay, we will be fair to you. If you are paying interest of even say 5 lakhs or 6 lakhs rupees, what best we can do is, to the extent of positive income, you can adjust the interest. That is, if your interest is more than 84,000 rupees, you don't have to pay any tax, and the interest is less than 84,000 in our given example, then you can adjust the interest and pay tax on the balance. So self-occupied house, annual rental value is nil, zero interest from housing loan is allowed. Let out property, there is a possibility of a positive income. To the extent of positive income, the interest can be adjusted and you don't have to pay tax on the income to the extent of interest on housing. This is something which we need to take care of. Then the worst thing, in my opinion, in my personal opinion, deductions under 80C, 80CCC, NPS and all are not allowed. Friends, we all know what is 80C, 80CCC, PF, LIC, ELS, everything we know. And with great difficulty, with a lot of efforts of ICAI and many of the investment consultants, we were able to instill that behavior of investments from many youngsters. What happens, friends, is it's a bit unfortunate situation, what I'm telling you, though not directly connected to tax. Ideally, we save money because the money saved by us now will help us at the time where we can not earn, that is post-retirement of age, or where we are unable to earn, where there is a loss of jobs and all. So in India, while you are earning, The correct policy is to save the money for our bad days. That's what our elders have taught us. And that came with a slight rider. What we started doing when people were not doing the saving, the government also came up with tax incentives and said, okay, you put in LIC, you put in PPF, you put in bank fixed deposits, we will give you tax benefit of up to 1,50,000. So a reverse thing started happening, but it was good for all of us, where at least because of tax saving, you started doing the investments. Now, my biggest worry here is employees who choose in the new regime will know that they are not getting a single rupee benefit from these investments made by them. And that is the biggest danger I see, where the employees may decide not to save. So where will the money go, sir? The money will go either in the stock market without proper knowledge, or the money will go in buying a higher model bike or a higher model car or a higher travel to some other country where they are not saving, but they are just spending the money. This is one danger, but let me not go into that. But what we'll see is nothing is allowed for ATC, ATCCC, National Pension System, where we used to get 50,000 rupees. If we deposit into NPS, we used to get tax benefit, extra 50,000 under ATC, that is not allowed. Then the worst part came was Chapter 6A. Many benefits were really genuine, really helping people. 80D, medical insurance. COVID has taught us that medical insurance is very, very important. We learned so many things, but also learned that all of us should have had medical insurance. And just when people started doing the medical insurance, 80D will not be applicable when you are in new regime. I'd also like to tell you one more thing under 80D, which might help you in the decision. Just keep that in mind because it's not very widely known thing. Now, friends, you have in your house your parents above 60 years of age. And unfortunately, at that time, you have not taken medical insurance on their lives. So you have, or you yourself is 60 plus, you don't have medical insurance. Now there is a provision where up to 50,000 rupees, you can submit medical bills and claim tax benefit. A salaried employee or a non-salaried employee, the moment you are in old regime, if you are above 60, you can claim tax benefit on medical bills up to 50,000 rupees. Okay, some additional self-imposed condition so that we have to satisfy the assessing officer. The bills should be in the name of that person who is above 60, and it is preferable. If we want to have a smooth life, it is preferable that the payment for such medical bills will be paid in any mode other than cash, because Section 80 talks about non-cash payments, which also can be implemented. But up to 50,000 rupees, I think 50% of us here should easily be able to claim that benefit of under 80. In the new regime, it is not available. There are many of us here, or at least some people who have mentally retarded dependents, physically handed dependents, or we ourselves are physically handicapped. I should not be using the word physically handicapped, say differently abled people. The moment you have that, we all know that for such family, the expenditure increases. And very rightfully, under the Income Tax Act, you were asked to submit a form where it is certified by a doctor or a government doctor, with certain degrees, stating the percentage of such disability. If the percentage is more than 80%, 1,25,000 is a straightforward deduction you get under 80DD for dependent, 80U for self being in that category. Just being in new regime, you lose that also. Then 80DDP, specified diseases. Check in the Google. Big list is there. One such example is cancer. Sir, you know very well if the person is in cancer. The moment we have a person in cancer, money starts flowing in like anything. The patient health deteriorates, the family's wealth deteriorates. These two things compete with each other. And in such a situation, the Income Tax Act was kind enough to give a deduction up to 1 lakh rupees if the age of the person is above 60, and up to 40,000 rupees if the age was below 60, subject to production of bills. Actual expenditure are 40 and 60, 1 lakh depending upon the age. Genuinely helping. This section is also proposed to be removed. You have taken education loan to go back and study. You know that you will earn well, whatever interest you pay, on the complete amount you had a deduction under 80E. Now, if you want to choose the new regime, then no benefit will be available under section 80E. 80G, our favorite section. We all do. COVID taught us to be charitable. COVID taught us to give donations. Very happy. People started choosing right forums. People started looking out for people who actually do the work. And if they were registered, if they had the 80G exemption, we were giving donations to them. Incidentally, we are also getting some tax benefit. So a good activity is going on every place. But now, if you want to choose to be in the new regime, 80G benefit also cannot be. Another one such small place where we lost the benefit, but this is not being discussed by many, thinking it's very unimportant, is 80 TTA interest on saving bank account. We all get tax benefit of up to rupees 10,000 under 80 TTA. If the actual interest on saving bank is less than 10,000, nothing you have to pay tax, and more than 10,000 on the differential amount, you pay tax. The government did a commendable job in restricting cash transactions. So all of us have accounts, all of us have multiple bank accounts. We are all getting this tax benefit on interest. Hardly we get 3%, 4% per annum. But government says, percent, you want to choose new regime and pay lower tax, forget even this interest. Now add whatever interest you earn and then pay the tax. We are not going to give any benefit. So this slide is very, very important, friends. That's why I have tried to explain each and every item. This is something which will be a very critical thing in deciding whether a new regime will be better to you or a old regime will be better. I'll come back to this slide within 5 minutes. Let me just go to the next slide where I say deductions which are also available. Now again, while promoting the new regime, the finance minister, with a good big smile on her face, she said, standard deduction of 50,000, which was hitherto available only for employees of the new old regime, will now continue for, will be available for the employees of new regime also. So, standard deduction of 50,000 for a salaried employee is not a deciding factor. So it is available both in old regime as well as new regime. So blindly a person can say, if a gross salary of an employee is 7,50,000, then from that 7,50,000, 50,000 can be reduced. So the taxable income will be 7 lakhs. Tax will be 25,000. Cess rebate will also be 25,000. So far, so good. Everything is great. Up to 7.5 lakhs, I did not have to pay 1 rupee tax. You go and update your bank passbook and you find 130 rupees interest issued by you for the entire year. Okay, you are happy that you are not paying tax, but is your happiness correct? No, because your income now is 7 lakh 130 rupees, which is more than 7 lakhs. So straight away, 26,000 plus tax is what you have to pay just because of this addition of 130. Be very careful there. Thankfully, employer contribution to national pension system. Yeah, I advocate this NPS strongly because people were not joining the NPS scheme and they joked with me saying, Pankaj, pagal hai kya? What will I do with the money at 58? I want to enjoy life now because the WhatsApp guru says, enjoy what is today. Why are you waiting for tomorrow? I said, WhatsApp gurus are very good, but the problem is they don't give you money and help you how to live after the point when you don't earn income. See that 60 years is a period till which all of us can work, we can earn, especially the salaried people, of course, professional, it is like me. So what happens is, we being in private sector, we don't have any pension coming in. So this NPS is a very good thing. So first we need to encourage everyone to go for this NPS and don't treat this 60 years as a long period. It is the very rightful period because when you can't earn and you get 30,000 rupees per month, the value is much high. When you're already earning 3 lakhs per month, what is the value of that additional 30,000 you get? I hope you understood what I'm trying to say. So this thankfully continues to be exempt in the new regime. So we can go for this. Of course, employer contribution to Provident Fund up to 12% of the basic pay continues to be tax-free, which is again a good thing. And we all know about the limit of 7,50,000, where the employer contribution to Provident Fund plus employer contribution to NPS, if the amount together exceeds 7,50,000, such excess and the accruals on such excess will be taxed. This is there in both the regimes, so this should not be a decisive factor. I would like to take 2 minutes here and also tell you. In between, the government had said that, the income tax department said, we are okay to give you a tax-free interest on the employee contribution to Provident Fund plus voluntary Provident Fund up to 2,50,000 per annum. Which means if your employee contribution to Provident Fund plus the voluntary Provident Fund is up to 2,50,000, you get interest, you don't have to pay any tax. But say if your contribution is 3 lakh rupees, then on 50,000 rupees, whatever interest you get, that would be taxable. Many cases we did, but it was not so high. But the media, everyone started saying we lost the money, aisa ho gaya, doob gaya paisa, and all these things. And there is a panic. which forced many companies to give PF option to put only 1800 rupees. And many employees jumped onto that 1800 scheme. I'm telling you, this is the first thing such employees have done. Giving you some reasons for that. 1800 rupees you contribute instead of 12%. What is happening? The money is coming out from the safest investment, giving 8% plus tax-free returns, and going into either bike or TV, or as people claim, into share market, which may give you plus 12% return or which may give you minus 12% returns also. We can't risk our future here. So that was the first loss. The second loss was up to 12% of basic is tax free. Now just imagine if your basic is say 1 lakh rupees per month, 12,000 rupees is tax free. Now what is happening? Because employee contribution is 1800, employer contribution is also 1800. So on the balance 10,200 rupees you are getting in hand, but you are paying 31% tax on that 31.2. So what is happening? It's one of the worst things, sir. Please encourage the youngsters not to go for that 1800 scheme. But of course, the 2,50,000 is there both in old as well as new regime. So that should not be a decisive factor for regime selection. Then we have 80CCH2, a new contribution, new scheme introduced in the budget. I don't know, they brought it in the act and they say contribution to Agniveer Corpus Fund by central government employee is tax free. They get any of so many exemptions. So here what is to be importantly read is that 80CCH2 is only for central government employees. So if employees of a private companies contribute to Agniveer Corpus Fund, there's no tax. Ravi, anything? You want me to stop?
No, sir. The questions have been flowing by the participants. Just let me know.
One more slide and I am done. Last slide. Okay.
Yes.
Just example say another. जो 10 मिनट लिए थे मैं वही टाइम से चल रहा हूँ. Give it. Okay. Right. Okay. So be very careful here. Then very quickly, as I said, let us see the example. I told you that employees in old regime and new regime are taken 7.5 lakhs as the starting point, where only standard deduction is given to both the employees. So even though I'm taking ATC of 1,50,000, 2,400 of professional tax and 50,000 of standard deduction, means 2,02,400 I am taking the benefit. What is important to know is it is never an apple to apple tax calculation, where the gross salary is 7,50,000. In the old regime, you calculate tax on 5,47,600, and in the new regime, it's on 7 lakhs. So please never calculate on a similar figure to decide which is good, but up to 7.5 lakhs, new regime is good. Quickly, I go to the higher figure, and because till the last from 2020 to this year, 2,50,000 was the cutoff point. So I took an example of 3 lakhs. So even for employer incomes above 15,50,000, if it is above 3 lakhs investment also, you will find that you are paying lower tax in new regime. And the cutoff figure which comes is this figure, which is 4,25,000. Now, for all cases above 15,50,000, friends, the break-even point where the tax is same in both the regimes is 4,25,000, including standard deduction. So in this example, I had like this. You find that standard deduction is available for both, but 2 lakhs housing loan, 80C, 80D, and all. If you are able to touch 4,25,000, I deliberately did for 27,400 because Even on this figure, the what you get tax benefit is 720 rupees only. So summing up, what I can tell you is, if you are able to get tax saving on an amount exceeding 4,25,000, including standard deduction and all, you should up to 4 lakhs at 4 lakhs 25 break even. Below 4 lakhs 25,000, which is now the case with 80% of us. It's totally reverse of the last 3 years. Many of us will not be able to do that. But if you are touching 425, you can, if you are lower than 425, old regime, higher than 425, a mistake, lower than 4,25,000, new regime will suit you. If your tax benefits are higher than 4 lakhs 25, old regime will be better. Choose wisely, because from an employer, what you choose now cannot be changed till the year end, and always better to check with auditor before filing of regime, which filing of taxes, which regime suits you. Because one thing, as a concluding point, friends, I have seen many articles where they are trying to write figures of income. I would like to say income figure has got nothing to do in choosing the regime, except above 5 crores. But below that, what is important is to see how much benefit you are getting on these things. If you are able to get on 4.25, 3 lakh 75 plus 50 standard deduction, more than that, old regime, less than that, new regime. And this is how you can choose the regime. Thank you very much for the patient hearing, friends. Raviji said there are some questions to be answered. I will take the questions, but I'll still be glad to answer any queries on pankaj.trivedi@tribune.com. I will stop sharing. Raviji, you can start the questions. But before that, thank you very much, friends.
So more than 1,500 participants have, more than 15% participants have joined the webinar. So the questions have been flowing. So although I think you have covered many of the questions in your wonderful presentation, but I would still like to take some of them so that members have a clear understanding of it. So the first question will be, are exemptions under Section 10 allowed under new tax regime?
No, all these are mostly for salaried employees which you are covering. All these are under 10 only, like 10.5, 10.14 and all. These are not available if you are choosing a new regime. Only in the old regime, you will get the benefit.
So to opt for old regime for AY 23-24, any specific form to be filled?
No, no form is to be filled for a salaried employee. Okay, so you can, you have been given an option to choose anything. The form was introduced in the first time when this regime thing came up, but that covered only business and profession. So a salaried employee can choose any regime year after year.
So the next question is the best possible salary restructuring for person having salary above 50 lakhs.
See, what happens is, as I told you in the concluding remark, salary restructuring is a very big topic, because I have to go study the company, study what is there in that company and all. But now tax and death are the only two certainties of life. Let us understand that. And for a salaried employee, collecting the tax has been thrust on employer. So what happens is, now when we are talking about choosing of regimes, 4,25,000 is the figure. That is the key figure. Structuring and all, let us not get into that in this session. Maybe we can have, if Gyanji or Kushaku permits.
So whether 30% deduction for house rental income is available for persons choosing new regime?
Yes, it is available for both the regimes.
Is marginal relief also available in new tax regime?
Yes, definitely marginal relief is available in the both the regimes. A very valid point raised by them. Yes, people who are in the marginal relief, that is, whose gross salary is between 50 to 52, 1 crore to 1 crore 6 lakh, that figures are there. They can blindly be in the old regime, because in the marginal relief cases, you are at 100% tax. Your income and tax are equal. So such people, if they choose to be in the old regime with standard deduction and investments, the taxable income will come down. That is also another blind area where people can choose the old regime is marginal relief cases. Blind area where people can choose the new regime is above 5 crore cases.
So a participant wants to know whether what was the real intention of finance minister to bring new regime, and was it really successful?
She said you don't even have to go to chartered accountants. You can do your own calculations. But I think after 30 years of practice, I had to form a group of 10 people, discuss it for 5 days to understand these two things. I don't know, sir. I'm not, maybe Pusharatam Das ji or Gyanji can give us that gyan on that.
Sir, there are many more questions, but I think you have
Yeah.
covered everything into your presentation. So
Thank you.
I would like to take this opportunity to express my sincere gratitude to our esteemed speaker, CA Pankaj Kumar Trivedi ji, for sharing his valuable insights and expertise with us in today's webinar. Pankaj sir has not only given us an informative presentation, but also engaged us in a fruitful discussion. His ability to explain complex concepts in a simple and engaging way has truly made this session a memorable one. The information shared in today's session will undoubtedly benefit us in our personal and professional lives. I would also like to thank all the participants who have joined us from various parts of the country. Your insightful questions have added immense value to this session. Finally, I would like to extend my appreciation to the CPE committee who have worked tirelessly to ensure the smooth running of this event. Without their hard work and dedication, this webinar would not have been possible. Once again, on behalf of all the participants, I, CA Ravijan, would like to express my heartfelt thanks to Pankaj sir for an enlightening and enriching webinar. Thank you all and have a great evening. I would now hand over the session to CA Rashmi Bangla for the next topic.
Thank you.
Thank you.
Sorry for delay 5 minutes. Thank you.
Thank you, sir. Thank you, Pankaj, sir. Thank you, Ravi. Very good evening to one and all. Myself, Rashmi Bhangla, moderator for this session. Welcome you all on behalf of CP committee. Our next session is on business combination and consequent purchase price allocation analysis by a very learned speaker, Hitendra Ranka, sir. Hitendra, sir, carries over a decade of consulting experience in the field of audit and assurance, accounting advisor, valuation and transaction advisory. Prior to founding the Ranka and Associates, he was at KPMG in audit and assurance practice. Hitendra's experience and key strengths include statutory audits under various GAAPS, INDAS, IGAAP, IFRS, US GAAP, and INDAS implementation, convergence for large corporates, including multinationals. He has assisted many companies, including listed ones, in their successful implementation of full-fledged INDAS. He is also specialist in financial modeling, valuations, and transactions advisory. He works extensively with foreign and domestic clients, as well as large transaction advisory firms for valuation engagements pursuant to inter alia issuance of shares, mergers, and acquisitions, impairment assessment, purchase price allocation, and measurement of intangible assets, and grants of employee stock options. He is also a registered valuer enrolled with Insolvency and Bankruptcy Board of India for asset class, financial asset and securities. It is our pleasure, sir, to have you with us, and I would like to invite you for the deliberation.
Thank you,
sir.
Rashmi, for your wonderful introduction. First of all, I would like to thank Chairman Sir Mr. Purushottam Khandelwalji and Vice Chairman Sir Mr. Gyanji. So when I discussed this, the topic on the today's webinar with them, they they immediately agreed for the topic, since this is like very niche topic and a very unique topic considering the current scenario where like a lot of deals in corporate sector are happening, maybe in startups or maybe in large corporates. So a lot of
Yes.
acquisitions, mergers are deals we are like seeing in the news articles on a daily basis. So my area of topic today will be the business combinations, which is obviously coming from Ind AS 103 business combinations, and
Okay.
the consequent purchase price allocation, which is more from perspective of the valuations, like how we value when a business combinations happens, especially where the valuation of the intangible assets is required rather than a normal business valuation. So just to set a context, I would like to share first of all my screen.
Sure, sir.
Just do confirm like if it's visible.
Sure, sure, sir. Yes, sir. It is visible, sir.
This is visible, yeah.
Yeah.
Yeah. So from context perspective, so first of all, we will just touch upon the relevant standards which defines the business combinations in AS 103, and then the same principles are there in the IFRS 3 also. Largely from at least from definitions perspective, it is almost a mirror thing in IFRS as well as from India's perspective. So business combinations are transaction or other event in which the acquirer obtains control of one or more businesses. So basically, here the definition is a business. The acquirer should obtain the control of one or more businesses. So, for example, if the acquisition of a business is happening, however, the control is not getting transferred, then in that case, this particular standard won't be applicable. So the transfer of control and ownership is most important for the business combination accounting under this standard. So once here the business definition also they have given. The business definition given is it should be integration of the processes, inputs as well as the outputs. So then only it will be considered as a business. Just mere asset acquisition won't be accounted under this standard. The asset acquisition will be accounted in other relevant standards. So for example, if it's a simple asset acquisition where it comprises of a tangible assets or maybe intangible assets, it will be recorded under the relevant Ind AS standards, like Ind AS 16 for the property, plant and equipment. So this standard will be triggered only when the acquisition falls under the definition of the business. So once we identify that the business is transferred from acquiree to acquirer, and the control has been transferred, this will be accounted under Ind AS 103, which is business combination. Now majorly like 4 to 5 steps in this standard which has been prescribed are: first of all, we need to identify the acquirer. So the acquirer is the entity which obtains the control of another entity. So if the control is not getting transferred, a mere, say, for example, 20-25% stake acquisition from the transferor entity might not fulfill this definition. So control is defined in a much larger way in Ind AS rather than just percentage of ownership. So even, for example, the transfer of stake is like say 20-25%. However, the terms are arranged in such a way where it's concluded that the control is getting transferred in the hands of the acquiring. Maybe it would be like by way of board representation on critical decisions, etc. In that scenario, the acquirer will be the person who is to whom the assets and business are getting transferred. So once the identification of the acquirer is there, then obviously we need to. So the second point is very important. All the accounting which will happen pursuant to business combination transaction will be relevant to the acquisition date. So acquisition date is very critical in business combination. So once acquisition happens, acquisition date where the actual control gets transferred from acquiree to acquirer, at that particular date, all the assets and liabilities will be recorded at their acquisition date fair value. And hence this entire exercise of purchase price allocation comes into picture, which needs to be done on the acquisition date fair value. So obviously then like once acquisition date is again identified, the recognition and measurement principles in the index comes into picture, which says like all the identifiable assets which are acquired and the liabilities which are assumed, including the non-controlling interest, needs to be accounted at the respective acquisition date fair values. Obviously, we will come at a later stage where we where we see like how like fair values for each of these assets and liabilities will be identified, including the intangible assets portion. And then the last one is, I mean, the differential portion from the consideration which has been transferred vis-a-vis the assets and liabilities which have been acquired. The differential will be accounted as a goodwill or bargain purchase in case there is a surplus of assets vis-a-vis the transfer of the consideration. So the concluding thing is from business combinations Ind AS 103 perspective is the acquired shall recognize separately from goodwill the identifiable assets acquired, the liabilities assumed, and non-controlling interest in the acquiree at their acquisition date fair value. Now, like earlier in normal accounting GAAP, under IGAP, we never used to, record the separately identifiable intangible assets at their acquisition date fair value. It was always like, the two methods were prescribed in case amalgamation in the nature of merger in the, I mean, the pooling of interest method, and the other was the purchase method. So here Ind AS has only one standard. There are no bifurcations in terms of like the pooling of interest method, etc. It just says like acquisition date fair values are to be accounted pursuant to the business combination transaction. So various gaps like US GAAP, IFRS, Ind AS require that fair value of assets and liabilities acquired in a business combination should be recognized in the financial statements of the acquirer entity. Now, purchase price allocation is such a technical process whereby this allocation of purchase price, or we can say, like consideration paid for the acquired business, is where the allocation is made between the identifiable, tangible, as well as intangible assets, and obviously the liabilities assumed in the transaction. So to arrive at the fair value of tangible assets, which could be, like factory, building, office equipments, all those things, those will be assessed as at the acquisition date about their respective fair values. So maybe, an external help from the land and building valuer, or maybe a plant and machinery valuer can be taken to assess the fair value on the particular acquisition date to conclude on the entire purchase price allocation analysis. Now, we as a chartered accountants, or maybe, like a registered valuer for financial assets and securities assets class, our role majorly comes to arrive a value of the intangible assets, where, like it's very technical part, and it's not impliedly, we can't judge basis the consideration price which has been transferred. So a separate exercise has to be carried out to value the such intangible assets. So so the allocation of the consideration price in the tangible as well as the intangible assets gives a clear picture in terms of how the business combination transaction should be accounted. So PPA also helps to calculate the amount of goodwill recognized pursuant to the business combination transaction. Goodwill here represents, as I said, the excess of purchase price over the fair value of the identifiable assets and liabilities assumed. Here, the against the earlier gap, here we will also consider the separately identifiable intangible assets to arrive at the value of the goodwill. So, so in a way, like, the goodwill will be a smaller portion as compared to the goodwill identified under earlier gap. The amount of goodwill recognized in the business combination can have significant implications for financial reporting, taxation, and future impairment testing. Now, the goodwill which we record as part of PPA exercise needs to be tested for impairment every year. So this is an accounting requirement where, like we identify basis various parameters, like if there are any impairment triggers like revenue growth or some market parameters which hints like, the overall business in which the company is might get affected. That warrants basically the impairment. So this assessment is to be done as at each reporting date. Obviously, for listed companies, it will be done like as a part of quarterly exercise. Now, as I said, like, the intangibles valuation is the most critical part, and where we need to see like how the international standards, valuation standards have been developed and have been followed to value such kind of intangible assets. So the very first check when we approach for the intangible assets valuation, or rather the purchase price allocation, we try to rationalize the projections. Obviously, the projections will be the base thing which will be used for the purpose of valuation of intangible assets. So just to ensure, like the projections provided by the client or the company are only are not having any acquirer specific synergies. We need to see like the projections which have been provided are only a market participant specific synergies. There are no acquirer specific synergy for which, like some gains have been contemplated in the projections. So here, how we define market participant is market participant specific refers to the perspective of a hypothetical buyer and seller in the market for the intangible asset who are assumed to be independent and well informed. In other words, the valuation should reflect the value that would be assigned to the intangible asset by a third party buyer who is not a strategic buyer. Obviously, for example, if I'm buying a particular business for my strategic, since I'm into the same business and I'm buying it for the strategic purpose, obviously the projections which I will be sharing will be much on a inflated side. So I would be, considering a 1 + 1 equals to 3 sort of growth here in the projections. So while valuing intangibles for the purpose of purchase price allocation, the acquirer specific synergy benefit should not form part of the projections. Otherwise, it will inflate the entire valuation of intangible assets, and accordingly, that won't be a fair basically. So only market specific parameters are to be considered. So any growth expected by way of synergy or say cost savings due to the synergy in the acquisition, those should not be considered while arriving at the while using the projections for the PPA exercise. So including the acquired specific synergies in the valuation can result in an inflated value that does not reflect the market value of an intangible asset. And accordingly, like our books will be inflated in terms of the relevant separately identifiable intangible assets. So it's always advised that first of all, a business entity valuation is performed, whereby we check, like the IRR basis, the internal rate of return, which is coming out of the projections which the client has given, is a market specific IRR, or it can be, like compared easily with the cost of capital of that particular industry in which the acquisition has happened. So by comparing IRR with the WACC, we try to confirm that the projections does not have any acquired specific synergy, and those are market participant specific projections. So in a way, this is the first basic very check which we need to do for all the purchase price allocation analysis. If we don't do this and simply take the projections which are shared by the client, obviously we won't be able to concluding our exercise of PPA in a right manner. So it's always advisable to do this as a first thing. IRR versus WACC should be compared. So IRR will be computed in a way using the goal-seek formula, maybe in Excel or maybe some other arithmetic techniques. So basis the projections which we have received from the client, we can arrive at the IRR, internal rate of return, at which like the cash flows will be equivalent to the fair value of the consideration. Now here, since we are touching upon the consideration part, which will be comparing with the business valuation. So the fair value of the consideration will be compared with the business or rather equity valuation of the company basis the projections which the company has given. The rate at which like both these things equates, that becomes your internal rate of return from such acquisition. Okay, so this IRR we will be comparing with the maybe a comparable company's WACC, or like a particular industry WACC to see there are no acquired specific synergies including the projections. If both these rates are significantly different, say for example there is a 1 to 2% difference in this, I mean in IRR and WACC, obviously we need to revisit the projections and need to discuss with the client in terms of adjusting the projections to avoid any acquire specific synergies. So this is the first check which we do for all our PPA analysis, and this is very critical. So now from consideration perspective, there are instances where sometimes the consideration is deferred, or there is a the part of the consideration is linked with, say, certain performance indicators, maybe with revenue or EBITDA for a future year. In that scenario, we need to arrive at the fair value of the consideration. Now, obviously, again, the fair value of the consideration. So for like here, I will take a simple example. Say, for example, the deal size is say 100 CR. I mean, the purchase consideration agreed has been 100 CR. Now, 50 CR has to be paid now on the date when the agreement is signed, and 50 CR is to be paid say after 6 months. Then we need to present value that 6 months to bring on the current date to arrive at the fair value. Because in days says like, you have to record the consideration also at a fair value. So consideration will also be considered at a fair value. Now this present value, this fair value of consideration will be compared with the business value, which generally we generally obtain by using a discounted cash flow technology as part of the income approach. So the equity value or the business value which we obtain will be compared with the present value of consideration, and will, by using the goal sig formula, will know like at which rate these are equating. So that particular rate will be an internal rate of return. So in a simple layman's words, this IRR basically reflects a return expected by a potential investor in this kind of projections or this kind of business. So this IRR, when we compare with WACC, we come to the conclusion that whether projections are appropriate or are a market participant projections, specific projections, and does not include any company specific synergy benefits. So this is the first check which we do. Now, if WACC and IRR are literally same, so maybe like 0.2, 0.3, 0.5 difference is fine. That can be accepted. It can be concluded that prospective financial information is market participant, and expected cash flows in terms of like consideration transferred equals the fair value of the business acquired. So in simple words, to ensure that prospective financial information is market participant specific and does not include any acquired specific synergy benefits, we should always carry out the business valuation of the company. So this is the first step in entire PP exercise, and arrive at the implied discount rate at which the equity value equals the fair value of the purchase consideration. The implied discount rate IRR so arrived is then compared with the industry WACC. So once this is done, obviously the measurement of consideration transferred will be there, which we already discussed. So contingent consideration is a financial arrangement in which an acquirer agrees to pay additional payments to the seller of a business if certain performance criteria are met in the future. The measurement of contingent consideration depends on the specific terms of the agreement. So obviously nowadays, when we witness a lot of share purchase agreements, a lot of business transfer agreements, we come across such terms which are very unique. Like at times, few terms are linked with your performance metrics for a future date. Say, for example, transaction is happening now, and something will be linked for a projected revenue or EBITDA for financial year 25. So part of the consideration is linked for some future date. So in this kind of scenario, even like certain technical valuation, certain very technical valuation metrics like Monte Carlo simulations, etc., are also used to arrive at the expected outcome of the consideration. So those are very complex like in nature, but for us, for this discussion purpose, we can simply consider our example of that 100 CR, whereby 50 CR we are supposed to pay today, and 50 CR will be paid say after 6 months. So the present value will be the fair value of the consideration as on the acquisition date, which we will be using for the purpose of purchase price allocation. So here, like for example, that 100 CR which we discussed as the consideration, the present value comes to say like 50 crore plus 45 crore, assuming like 5 crore is a present time value impact. then overall consideration, fair value consideration will be 95 CR. Now, this 95 CR is something which we need to allocate into various identifiable as well as identifiable assets as well as intangible assets, including the liabilities assumed in the transaction. So that's what the entire exercise is all about, the purchase price allocation. This 95 crores needs to be allocated to different assets, including intangibles as well as the liabilities assumed. And the differential portion will be obviously the goodwill or maybe bargain purchase in case of surplus. Yeah, so as I said, like, to determine the fair value of contingent consideration, companies may use various techniques such as DCF, discounted cash flow analysis, option pricing techniques, which includes, Monte Carlo simulation, or maybe a Black-Scholes model or a binomial model. The assumptions and inputs used in this model should be based on reasonable and supportable information, including market data, historical performance, and management's expectations. Now, the most important part for we as a chartered accountants in the PP exercise is the valuation of the intangible assets. Now, these intangible assets, apart from purchase price allocation analysis, can be, valued separately for, say, some financial reporting purposes. Obviously, from business combination perspective, which is mergers and acquisitions. It can be also independent. I mean, an independent company can obtain independent opinion on intangible assets valuations for, say, its licensing and franchising purpose, maybe for some internal management purpose. It can be also for the purpose of seeking finance. And it can be also for, impairment testing or maybe a transaction support engagements. So these are, so this particular slide gives an idea on the various intangible assets. So I've plotted this category wise. So in marketing related intangibles, which largely covers trademarks, unique trade design, internet domains. Now, since, a lot of D2C startups are gaining attraction, and a lot of them are unicorns these days, customer relationship is something which we are witnessing now and then as an intangible asset to be recognized in a lot of PPA exercise. So customer-based customer contracts can be your intangible asset. A customer list can be your another intangibles. Customer relationship, which can be contractual as well as non-contractual. This can also be your intangible assets. We'll just give you a simple example of customer contracts. So, for example, a company which is into a renewable power sector, they have generally this power purchase agreement signed for, say, 25 years. So, so the structure is such, like, one holdco will be there, holding company will be there, and there will be, say, special purpose vehicles under that holdco, which will be like obviously 100% subsidiaries of that holdco. So each of these subsidiaries are formed for the purpose of this renewable power, for the purpose of this renewable power generation. And they have majorly, the contracts with the government, state governments, and other agencies. So all those contracts will be like power purchase agreements. Those are the contracts which helps company to generate a revenue for a specific, say, 25 years period. And from the day when they sign the contract, they are clear about, what will be the operation and maintenance costs, what will be their admin costs, what will be their financing costs. Generally in this industry, 70:30 is the debt equity ratio. So considering all those things, I mean, so for them, like, the most important intangible asset is customer contract only. Like, if that power purchase agreement is not there, I mean, they don't have any business value, to be very frank. So customer contracts here is the most important intangible asset which needs a separate valuation. Similarly, for few companies, there are customer relationships which could be recognized as a separately identifiable intangible assets. Now, this customer relationship can be, say, in form of, like, you have, say, customer lists which can be used by the acquirer to, market to market their products to those existing customers of the acquiring. So those can be a particular intangible asset. Then there are artistic related intangible assets like royalties, which are generally valued considering the relief from royalty method, copyright protection, motion pictures. Again, there could be, so for example, if the acquirer has various, long-term lease contracts, obviously a favorable lease contracts or certain permits, those when acquired by acquirer, needs to be separately valued as an intangible assets. So now the instances could be, the acquiree might not be, recording this as a separately identifiable intangible assets in their financial statements. However, once the acquirer acquires this as a part of the business combination transaction, this needs to be separately evaluated and accounted. So again, there could be, like in the business transfer agreements, there could be clauses which says, which talks about the non-compete agreements that also needs to be evaluated separately, and that also need to be accounted separately as an intangible asset. There could be other category which is technology based, which can have patented or non-patented technology, software, formula, etc. Those also needs to be separately valued. Now, the most important thing, like how we value this, we have discussed like this intangible, there are various categories of intangible assets, and this needs to be evaluated from a purchase price allocation perspective. Now, how actually we value this intangible assets? So this is like not a topic of an hour to discuss like entire all approaches and everything, but for simplicity, we can discuss maybe the generally applicable method to record customer contracts or relationship related intangible asset. We can maybe discuss multi-period excess earning method as part of this discussion. So just to give a background from valuation perspective, there are three broader approaches which are followed as per the international valuation standards, and obviously now the ICAI RVO valuation standards also. So cost approach is there, market approach is there, income approach is there. Under cost approach, there can be like replacement cost method, there can be NAV method, there can be adjusted NAV method. Again, under market approach, there can be valuing a company using the historical valuation multiples. We can use based on the market price method. If the company is a listed company, we can use the comparable companies transaction multiples or comparable companies market multiples. So for example, I have a XYZ company which can be compared say with Reliance or Tata, then probably since those are the listed companies, I can use the valuation multiples which are publicly available. So we can use say PE multiple or maybe EV by revenue multiple to value those companies. So those are covered in the under market approach. From income perspective, the most widely accepted method is discounted cash flow method. So this broader category is more from the perspective of the business valuation rather than the intangibles valuation. So intangibles valuation has again like a different set of methods, but obviously it goes without saying that first point in entire PPA is the business valuation only. That will be done mostly by say discounted cash flow method or maybe using the market multiple approach. And then once that is done, we intend to give some value to the intangible assets. There we can use these various methods like excess earning methods, with and without method, relief from royalty method, greenfield method, and distributor method. Now again, these methods, again, this will be applicable like for the specifically for various categories of intangible assets. So maybe it's like say, since we discussed this customer-based intangibles in length, for customer-based contracts, the multiple period excess earning method could be the most relevant method, or maybe the distributor method could be another method which is relevant. For non-compete related agreements, with and without method could be relevant. So considering the time, maybe we can discuss probably this customer relationship related intangible asset valuation by using the multi-period excess earning method. Now, what is basically customer related intangible assets? So customer related intangible assets include customer lists, backlog, customer contracts. It can be contractual, it can be non-contractual. A valuation analyst should consider important elements that create this intangible asset. So first important aspect when valuing the intangible asset is, the identification of the intangible asset, because the standard Ind AS 103 clearly says that if the asset is separately identifiable, then only, further evaluation in terms of its valuation is required. So the most important aspect here is for customer relationship based intangible asset to exist, it must have a informational context. So here we are limiting our discussion with respect to customer related intangible assets only. So from a customer relationship perspective, it must have a informational component or factual information about the customer. It can be, say, name, contact details, buying preferences, etc., which can be useful to the acquirer company. So assuming like after this COVID, a lot of this pathology and pathology labs stocks were skyrocketing, and even in an unlisted space also we have seen great valuations peaking in this space. So even a lot of this kind of large chains are acquiring small labs on a pan-India basis. So when they acquire that small lab, they get details in terms of the customers, their contact details, what kind of tests they are doing, at what intervals they are doing. So those kind of relevant information can become a useful information which can be used by the acquirer company to further market their products, or maybe to have some synergy benefits. So then there is an from such customer relationship, there is an expectation that there will be recurring business for the company. So if I give a list of customers, considering the same this pathology lab example, I get to know, like, for every 6 months this particular person is say going for a lipid profile check or a full body checkup. So that as acquirer company into a pathology business, this becomes a useful information for me, and this could like lead to a recurring business for the overall company. So this is a relevant intangible asset which warrants a separate identification, which needs a separate valuation. Customer related intangible assets create value for a definite finite period. Over a period of time, customer lists will reduce due to the customer mortality, competition, etc. So obviously this particular intangible asset is not like for an indefinite period. It always comes with a definite period. So considering the historical data from the acquiring company, we need to evaluate, like, I mean, what is the life cycle of a particular customer. So here in a technical term, we generally arrive at the attrition rate. So for example, if ABCD customers were there in the last year, say 22, then how many are going to repeat in, say, 23? It can be, say, like ABC. In that scenario, 75% is my retention ratio and 25% is my attrition ratio. So assuming for the simplicity's sake, this 75% every year, like, it will replenish, say, by 25%. So effectively it's a 4 years life for this particular intangible asset. So this intangible asset will be recorded at acquisition date fair value, and then it will be depreciated over the useful life of 4 years. So there where the impact of computing the life comes into picture. Now these assets often create value of the company along with the use of other assets by the company to generate earnings. Example, property, plant and equipment, working capital, and other intangible assets. So even if I have these intangible assets, having alone these intangible assets won't generate a cash flows and a business for the company. Obviously, there are various other contributory assets like property, plant and equipment. It can be working capital. It can be other intangible assets. It can be skilled workforce, etc., which will lead me to a desired cash flow. Okay, so there are various contributory asset charges for which like we need to arrive at the contributory asset charges. So assuming like we arrive at a value of the intangible asset, the basic value, say for example 25 CR, and there are various contributory assets which need some portion needs to be appropriated to them, say 15 CR. Then the net value allocated for the intangible will be only 10 CR. So to arrive at the contributory asset charge is also very important aspect. Now the second, so this we understood about the meaning of the customer based relationships or contracts where like we can record the intangible asset. Now the second aspect is important steps for valuation of customer relationship based intangible asset using the multi-period excess earning method. So first of all, yeah, it goes. This is the first step to start with revenue estimate with appropriate attrition. So since I explained you like this particular assets will have a definite life, So a revenue estimate needs to be done for this particular intangible asset with an appropriate attrition. Then again, contributory asset charge needs to be determined. Yeah, so a charge, typically I can tell you, like, this is the internal rate of return for each of this asset, like property, plant and equipment, working capital. So this we'll discuss, I mean, in the second point here, when we talk about the contributory asset charges. Then rate of return and risk adjusted discount rate. So the general principle is the WACC, the weighted average cost of capital, or the discount rate which we use for valuing the business which we have acquired, will be lower as compared to the WACC or discount rate which we use for intangible assets. It's always like a hierarchy where, like, risk-based classification of the assets is done, and accordingly discount rates are allocated. So assuming, like, the most risk, I mean, the lesser riskier assets will come first. Say, for example, property, plant and equipment will be lesser riskier asset, because it's just simple like that equity ratio. You will apply 70:30, 70:30 to fund that asset. So that's the return which you are expecting by using this property, plant and equipment. Then there could be other working capital related items where there will be lesser discount rate. The goodwill will be the most riskiest asset in this hierarchy, and in between there will be this separately identifiable intangible assets. So assuming, like, your discount rate for the overall business is, say, 15%, then in that case it will be at least, say, 5-10%, 15-20%, considering the various facts and other circumstances, it will be higher. I mean, the discount rate for this customer relationship will be higher. Typically we have witnessed, like, generally 5 to 10% premium is there in valuing this intangible assets. So the first important thing is we need to have the revenue and cash flow estimate with appropriate attrition. So to further use this multiple period excess earning method to value the intangible assets. So under this method, revenue and cash flows derived from the subject intangible assets needs to be determined, and then cash flows attributed to contributory assets need to be deducted. This requires estimating the revenue from repeat business from the existing customers as of the valuation date. Since the customer relationship assets derive value for a finite period, the number of customers providing business in future reduces over a period of time. So attrition is a measurement of loss of existing customers. Here, if historical data is available, it may be used to arrive at the expected annual attrition rate. The attrition rate so arrived is then applied to projected revenue stream from existing customers to arrive at the expected revenue over the period of economic life of the this asset. So I would just suggest to like understand here from a conceptual perspective, because this can be explained in a better way, maybe by using Excel sheet where we can plot all these numbers. I mean, first of all, the business valuation is done. Then probably this revenue and cash flow metrics are done for the purpose of using this multi-period excess earning method. So I mean, let's focus on the conceptual part for this discussion. Then the other thing, which obviously the first step where we have arrived at the revenue and cash flow estimate. So cash flow estimate, as in we will arrive at the free cash flows available at this stage. And then, I mean, basis the free cash flows which are available in part A, the contributory asset charges, which has been measured for relevant other supporting assets, which helps in generating the revenue or projected for this particular intangible assets, needs to be reduced, so that we are not, ending up in inflating the intangible asset. So, so typical internal rate of returns or IRR for property, plant and equipment, working capital, and other intangible assets, etc., will be arrived at, and those will be applied on the average cost or value of those assets to arrive at the contribution charges, which then will be reduced from the revenue and cash flow estimate as per point A here. Now here, any non-operating assets we don't contribute in the estimated earnings should not be considered as contributory assets. So only the assets which helps in generating the revenue as identified in point A will be considered as a deduction from this free cash flows counted in point A. rate of return, and risk-adjusted discount rate. The determination of the appropriate discount rate to be used to estimate an intangible asset's fair value requires additional consideration as compared to those used when selecting a discount rate to determine the enterprise value or a business value. Selecting discount rates for intangible assets can be challenging as observable market evidence of discount rates for intangible assets is rare. The selection of a discount rate for an intangible asset generally requires significant professional judgment. In selecting a discount rate for an intangible asset, valuers should perform an assessment of risks associated with subject intangible asset and consider observable discount benchmarks. So as I said, this process of determining the risk or rate of return or the risk adjusted discount rate for a particular intangible asset will start with the discount rate which we have used for the business valuation in the very first part of PPA which we discussed. So that will be used as a base rate, and obviously then additional risk premiums will be added to that discount rate to arrive at the discount rate for intangible assets. Obviously, it will be considering the various factors such as intangibles assets often have higher risk than tangible assets. If an intangible asset is highly specialized to its current use, it may have higher risk than assets with other potential uses. So for example, if a particular software is acquired as part of the business combination transaction, which can be, like say used for only by the treasury management companies. So that's a very specialized use of that particular software. So assuming, some technology development happen in a treasury industry, that software might not be of much use. So for such intangible assets, which has a very specific use case, a higher discount rate, will be used as compared to the other intangible assets. Like for example, in our example for this renewable power companies, where we discuss about the power purchase agreement. Now that PPA can again, be shifted maybe from one producer company to say other producer company. In that case, that will have a lower discount rate as compared to the software related intangible assets. Single intangible assets may have more risk than a group of assets or businesses. Intangible assets used in risky, sometimes referred to as non-routine functions, may have higher risk than intangible assets used in more low risk or routine activities. The life of the asset, similar to other investments, intangible assets with longer lives are often considered to have higher risk. So if there are longer lives determined for a particular intangible asset, those tend to be very risky, and obviously a risk adjustment additional percentage is required to arrive at the adjusted discount rate for such intangible assets. Intangible assets with more readily estimable cash flows, such as backlog, may have a lower risk than similar intangible assets with less estimable cash flows, such as customer relationships. So in our example, like customer contracts, where we can with some sort of surety, we can tell like this will be the cash flows, say for a next 10 years. However, in case of customer relationships, where we just have the contact details of the customers and some past data, I mean, the surety percentage is reducing here. So in that scenario, again, the risk, the discount rate will be increased. Economic life. So an important consideration in the valuation of an intangible asset is again the economic life of the asset. This may be a finite period limited by legal, technological, functional, or economic factors, or other factors may have an indefinite life. So all separately identifiable intangible assets have a temporary life, don't have an indefinite life, and needs to be depreciated over or amortized over the economic life of such assets. Like in our example, if the power purchase agreement is of 25 years, 10 years have elapsed. In that case, 15 years will be the economic life for that particular asset. For customer-related intangibles, attrition is a key factor in estimating an economic life, as well as the cash flows used to arrive at the customer-related intangible assets. Attrition applied in the valuation of intangible assets is a quantification of expectations regarding future losses of customers. While it's a forward-looking estimate, attrition is often based on historical observations of attrition. So obviously the historical data from the acquiree will be useful to arrive at the attrition rate. Then the last thing is tax amortization benefit. Now, under the income tax regime also, the tax depreciation is allowed on such identifiable intangible assets, and it's not allowed on goodwill. So obviously this will lead to savings in the cash flows in terms of reduced tax outflows for future years. So tax amortization benefit is something which needs to be added in to arrive at the overall value of this intangible assets. So assuming like you have say a tax rate of a 10% for a particular intangible asset, which will and it has a say life of 10 years, then 10 years you are going to get the benefit in terms of reduced tax outflows, because the value which has been considered for intangible asset will be used to depreciate for further 10 years. So obviously there is a tax saving and which will again lead to increased free cash flows year on year, which needs to be assigned a value for it. The present value of intangible assets projected cash flow should reflect tax saving that may result from claiming depreciation on such intangible asset. If the market or cost approach is used to value an intangible asset, the price paid to create or purchase the asset would already reflect the ability to amortize the asset. However, in the income approach, a tax amortization benefits needs to be explicitly calculated and added. So in most of the scenarios, you will find that intangibles are always valued using the income approach rather than the cost approach. So this tax amortization benefit is something which we need to calculate. So this is the last step, where we arrive at the value of the intangible asset. So this is the most important part in the entire purchase price allocation, where we as a chartered accountants can give our value. And this is a very nascent or maybe a very niche area where a lot of people are not practicing. So this could be beneficial, I think, to the members or the young members who want to jump into this profession. I think we can close the presentation here. Maybe we can take up the questions now.
Yes, sir. So we can close the questions. And sir, I think you have covered each and every questions of our participants. We have more than 1,500 plus participants, but we don't have a single question. It means each and every questions have been answered in your deliberation. Thank you for the wonderful deliberation, sir. Thank you.
Thank you. Thanks.
So moving forward to conclude the session, I feel immense pleasure to propose a vote of thanks to Hitendra Ranka, sir. I want to express my sincere gratitude to sir, who has spared us precious time from his busy schedule and enlightened us with innovative ideas on business combination and purchase price allocation analysis in this webinar. Thank you so much, sir.
Thank you. Thank you very much.
I would especially thank CP Committee Chairman Purushottam Khandelwal, sir, and Vice Chairman Gyan Chandji and Ajit Nath, sir, for organizing such a wonderful webinar and giving me the opportunity to be part of it. And I would also like to thank all the participants to join this webinar. Thank you, Pankaj, sir, for the wonderful deliberation. Thank you. Thank you, sir.
Thank you, Hitendra ji. Bye.
Thank you. Thank you, sir.
Thank you, sir. Thank you. Leave. So now I suppose we can leave, sir. Hello. So Ravi, we can leave, I suppose.
Yes, of course.
Anything else?
No,
Krishnakant,
that's
sir.
it.
Ajit, sir. Anything else? एयरपोर्ट 0 हो गए जो कंटिन्यूस 3 घंटे लगाई तो बंद
Recording stopped.